Good morning. It's Mike Lynch with AmeriFirst Financial, and it's time for your Monday morning mortgage update for the week of July the 26th. Happy Monday. Hope everybody had a great weekend. Gayle and I had a fantastic weekend. We actually got to check something off our bucket list. I took Gayle down to San Diego and we watched the thoroughbreds run the Del Mar racetrack. It's been closed since COVID started. What a great experience. Amazing animals. Just had a wonderful, nice, cool weekend as well. So what happened last week in the bond market? What's going to happen this week? So last week really wasn't much change to rates. We saw a little bit of volatility, but really not much of a change, even though there was some increased trading and pricing in the bond market. So let's review. What's that mean? We know that mortgage interest rates are determined by the trading of mortgage-backed securities in the bond market. And people put their money in one of two places, the riskier stock market or the safer bond market. So when everybody's feeling great about the economy, they know where their next paycheck's coming, they got money in the bank, money typically shifts to that stock market. They're willing to take more risk, and it flows out of the bond market, and that typically causes mortgage rates to go up. On the other side of it, if there's uncertainty, maybe not sure where your next job's coming from, are you going to have a job in a couple months, not much in savings, then money typically flows out of the riskier stock market and into the safer bond market, and that drives mortgage rates down. So we all know that since the pandemic started, the federal government has been dumping billions of dollars into the bond market, driving those mortgage rates down, which is why we've been seeing such amazing interest rates for mortgages. So what are we looking at this week? What are the three things? We're looking at the Fed. They got a meeting this week. We're looking about inflation and GDP, gross domestic product, and then economic data. So the Fed has another meeting this week, starts Tuesday, ends Wednesday, and they'll come out Wednesday afternoon and tell us all what they talked about. It's not a policy meeting, so they're not going to move interest rates or anything like that. They're just going to talk about the economy. And the big discussion that everybody is going to be paying attention to is what are they going to do about tapering? When are they going to taper? So bond traders that trade in the bond market, they're more conservative. They want to see long-term economic projections. They're going to trade based on long-term economic outlooks, not on day trading like the stock market does, where stuff goes up and down overnight. So the bond traders are looking at when is the Fed going to stop or slow down their purchase of mortgage-backed securities. We call that a taper. If they start buying less of those, the free economy, somebody has to come in there and make up that difference, or we're going to see mortgage rates go up. So who invests in the bond market? Your 401ks, professional investors, foreign investors, all kinds of people invest that money in the bond market. And if the Fed backs out, if they taper and start buying less of those mortgage-backed securities, which they've been doing since the pandemic started, then are we going to see those mortgage rates go up? Do the bond traders think ultimately, if that happens, when it happens, which could be the end of this year, first part of 2022, are we going to see those rates start to creep up a little bit? Is it going to be offset by maybe a weakening economy? Who knows? So we'll be watching what the Fed really says about that taper. The second thing is inflation and GDP. So we all know inflation is the worst thing high inflation is the worst thing that can happen for mortgage rates. It drives mortgage rates up. We've been talking about this all year, that inflation is going to really continue to increase into the summer. We've seen it happen. And this week, the PCE report, the key measure of, or the Fed's favorite key measure of inflation, is coming out this week. We had the CPI last week, which showed big inflation. PCE, we expect it to be above 3, high 3s or low 4s, really high number, which absolutely should drive those mortgage rates up and pricing the bond market down, mortgage rates up. And then the other thing is we're going to get on Thursday, we'll get the revised GDP numbers for the second quarter, gross domestic product, which shows a growing economy. We expect that above 8%, and that's another bad thing for mortgage rates. We could see those go up as well. And then the third thing is economic data. Just a lot of economic data coming out this week. Durable good orders, consumer confidence, PCE, as I talked about, multiple Treasury note auctions, how the Fed raises money. A lot of housing data is coming out this week. So what are we doing this week? We're really floating into Wednesday. Once the Fed comes out with the minutes of their meeting and really tells us what they think about inflation, about tapering, and then Thursday, the GDP numbers come out, And then Friday, the inflation numbers come out. We expect a lot of volatility at the end of the week. So floating into Wednesday, and then really watching the market, cautiously floating, being ready to lock if we see the market get worse. So if you know somebody or have a client that needs some advice on mortgage rates, feel free to give me a call. All my information is down below. If you know somebody who could benefit from this video, please forward it to them. If you have any questions or comments, I'd love to hear from them. Have a wonderful, productive week, and we'll talk to you next Monday. Bye-bye.